Lesson 1. Not all earnings are visible, but they're still real. Imagine this. You buy a stock. Let's say you own 5% of a great company like Coca-Cola. That company earns profits. But instead of paying you dividends, it reinvests those earnings back into the business. So you don't see that income on your personal account. Does that mean you didn't make money? Absolutely not. Warren Buffett in 1981 explains that non-reported earnings, those retained by the companies Berkshire owns partial stakes in, are still building value, even if they don't show up on Berkshire's income statement. This is a subtle but powerful truth. Real wealth is often invisible in the short term, but it grows quietly over time. Buffett believed those retained earnings, if reinvested wisely, add just as much to shareholder value as any dividend. But traditional accounting doesn't count them until they're distributed. That's why he told shareholders, don't judge value by reported earnings alone. Look at what the underlying businesses are doing with their profits. Takeaway? Just because you don't receive a dividend doesn't mean you aren't earning. If the company reinvests well, your wealth is still growing, silently. Lesson 2. Partial ownership of a great business is better than full control of a mediocre one. Most people think, if I don't control the whole company, how can I make real money from it? But Warren Buffett turns that idea on its head. In 1981, he wrote that owning 10% of a wonderful business is often better than owning 100% of a mediocre one. Why? Because great businesses earn high returns on capital, require very little to grow, and reinvest wisely. Compounding over time, meanwhile, owning a mediocre company just because you control it can be a disaster. You might have full power, but the economics work against you. Buffett realized that buying small pieces of high-quality public companies gave him exposure to the same powerful compounding, without the headaches of full ownership. So instead of empire building or chasing control, he focused on economic performance. This was revolutionary thinking at the time, and it still holds today. Takeaway? You don't need to own a whole company to build wealth, just own a slice of the right one. Lesson 3. Buying bad businesses doesn't turn out better, even with a kiss from a great manager. There's an old fairy tale where a kiss turns a frog into a prince. But Warren Buffett said in 1981, in business, that doesn't work. Many companies at the time, and still today, make the same mistake. They buy weak, unprofitable businesses, hoping that great management will magically transform them. But here's the truth Buffett learned. Even the best managers can't fix fundamentally flawed businesses. He called these deals managerial kisses. Charming but foolish, because no matter how good the CEO is, if the business needs constant capital to stay afloat, has poor economics, lacks competitive edge, then no kiss can save it. It's like pouring water into a leaky bucket. Buffett warns investors and companies alike, don't fall in love with the idea of fixing broken businesses. Instead, find ones that are already excellent. Takeaway? Even great managers can't fix bad businesses. Buy quality, not a turnaround story. Lesson 4. Inflation is a corporate tapeworm. It eats returns from the inside. Inflation. It's one of the quietest destroyers of wealth. In 1981, inflation in the US was sky high, over 10%. And Warren Buffett didn't hold back. He called inflation a corporate tapeworm. Why? Because it consumes a business's internal strength without being noticed immediately. Here's what he meant. In inflationary times, even if a company earns the same profit on paper, it has to spend more on raw materials, pay more for labor, replace equipment at higher prices, and hold more cash just to survive. The result? Real returns shrink, capital requirements grow, and most of the profits are swallowed before they reach shareholders. Buffett was warning investors, don't be fooled by rising earnings during inflation. What matters is what's left after inflation has eaten its share. Only businesses that can raise prices without losing customers or that require little new capital to grow can thrive in this environment. Takeaway. Inflation quietly eats profits. Invest in businesses with pricing power and low capital needs. Lesson 5. High interest rates can make even good businesses look bad. In 1981, government bonds in the US were yielding over 16%, risk-free. Warren Buffett raised a critical point. If investors can earn 16% from a government bond, then businesses need to do better than that to even be considered a good investment. Let's break this down. A business that earns 12% on equity might look solid in normal times. But in a world where bonds give 16% safely, that 12% return becomes unattractive. Now here's the trap. Many investors keep looking at company profits in absolute terms, not relative to the alternatives. Buffett warns that during periods of high interest rates, many companies don't generate enough to justify their stock prices. Reported earnings look okay, but real value creation disappears. The risk-adjusted return doesn't beat passive income options. That's why in those years even good companies looked like bad bets, simply because the bar was too high. Takeaway? A business must beat the risk-free return. If interest rates are high, average returns just aren't enough. Lesson 6. Dividends versus reinvestment. The rule of return. Warren Buffett, in 1981, dropped a powerful insight about capital allocation. If a company can reinvest profits at high returns, it should do so. If it can't, it should return the money to shareholders. Let's simplify that. When a business earns a profit, it has two choices. Reinvest it into the business. To grow, pay it out as dividends. Give it back to shareholders. Now, if the company can earn 15–20% on reinvested capital, that's great. You want it to reinvest, because your money is compounding faster. But if the business earns only 5–6%, reinvesting that money is a waste. In that case, paying it out to investors is better. Buffett's rule is simple. Capital should go where it earns the best return. It's just like you choosing between two fixed deposits. You'll pick the one with higher interest, right? Same with companies. Management must treat retained earnings like investor capital, not company money. Takeaway? If a business can't earn high returns, it should give you the money back. Reinvestment only works when it compounds fast. Lesson 7. Inflation forces bad businesses to keep more money and waste it. Here's something ironic and painful. Warren Buffett points out in 1981 that during times of high inflation, the worst businesses often end up retaining the most money. Wait, what? Why? Because they're forced to. Let's say a company makes shoes. As prices rise, the cost of leather, rubber, wages all go up. So to keep selling the same number of shoes, the company has to invest more and more capital just to maintain its size. And here's the problem. These businesses already have poor economics. They earn low returns on the money they spend. So when inflation forces them to hold on to more capital, they just destroy more value, faster. Buffett compares this to feeding a failing machine more fuel. It doesn't fix the problem. It just burns through resources. Smart businesses, on the other hand, need less capital to grow. So they survive inflation better and actually create value with retained earnings. Takeaway? In inflation, weak businesses hoard cash but waste it. Strong businesses do more with less. Lesson 8. Look for tapeworm-resistant businesses. Warren Buffett had a gift for using simple words to explain complex ideas. In this lesson, he called inflation a corporate tapeworm. Why a tapeworm? Because just like a parasite inside a body, inflation consumes resources quietly from within. A company might appear healthy on the outside, revenues growing, products selling. But if inflation is high and the business needs a ton of money just to operate, then most of the value gets eaten before it reaches the shareholder. It's like this. If your business earns $100, but inflation forces you to spend $90 just to keep up, what's left for you? Just $10. Now compare that to a business that earns $100, but only needs $30 to keep going. That's a stronger, tapeworm-resistant business. Buffett said, look for companies that can protect their profits, even when inflation bites. They're rare, but when you find them, they're worth holding forever. Takeaway. Inflation eats business value from the inside. Only strong, efficient companies survive it. Lesson 9. Book value doesn't always tell the full story. In the 1981 letter, Warren Buffett makes a humble confession. Berkshire Hathaway's book value went up, but he warns shareholders, don't get too excited. Most of that growth came from market prices going up, not from operating performance. Let's understand that. Book value is the accounting value of a company's assets minus its liabilities. sort of like what it's worth on paper. But here's the catch. Book value can rise simply because stock prices of owned companies went up. That doesn't mean the company itself is performing better. It's like your net worth rising because your house value appreciated, not because you earned more. Buffett wanted investors to understand that real progress comes from better business operations, not just market mood. So he urged people to dig deeper than the numbers. Look at how much cash the business generates, how efficiently it reinvests, and whether the moat is getting stronger. Book value can be misleading, especially in inflation or bull markets. It can hide weaknesses or inflate strengths. Takeaway: don't trust book value alone. Real business performance matters more than accounting numbers. Lesson 10. Be humble, stay adaptable. Even the best make mistakes. Warren Buffett, in all his success, never claimed to be perfect. In fact, in the 1981 letter, he openly admits mistakes, even those made just months earlier. He had predicted slower inflation, but when that didn't happen, he said, "We were wrong." Now here's the magic of that moment. He didn't double down. He didn't make excuses. He just adjusted, quickly and rationally. This might seem small, but it's huge. Because most investors get emotionally attached to their views, refuse to change course, and turn small mistakes into big losses. Buffett teaches us that investing isn't about always being right. It's about being quick to fix when you're wrong. Adaptability beats arrogance. Discipline beats ego. It's this humility that helped him thrive across decades, through recessions, inflation, tech bubbles, and beyond. Takeaway? You don't have to be perfect, but you must be flexible, fix mistakes fast, and move forward. Warren Buffett's wisdom from 1981 is just as relevant today, maybe even more. These lessons are simple, timeless, and brutally honest about how wealth is actually built. If you found value in this breakdown, do 3 things. Like the video so more investors can learn what really matters. Subscribe for more clear, long-term investing insights. Comment below. Which lesson hit home for you the most? And remember, you don't need to be a genius. You just need patience, clarity, and a plan that compounds. Thanks for watching. Stay rational. Stay invested.